Have you ever heard of the term investor's generation? The origin of this interesting term came in 2020 by Charles Schwab study, when they found out that 15% of all current U.S. stock market investors got their start in 2020, and investing is a high-potential industry, and it's not a place where you play the Russian roulette, because here the mistakes cost you money. So how to learn what not to do is the primary quest, in which one must do his primary research before learning how to do it. To study, one can either play smart by learning from the mistakes of pioneers, or can learn from the school of hard knocks. But let's put it this way, you receive an investing mistake that happened a few years ago, and you can see the valuable lesson, but the truth is everything in investing is time-based. The market fluctuations do affect every high-potential product, so there might be a chance that the advice can be irrelevant in the present time. So learning from the mistakes should go in hand with the present market study. On the other hand, let's just say nobody is crazy enough to gamble with their hard-earned money just to acquire some hardcore knowledge. So instead of becoming a masochist, let's play smart. As Sam Levinson once said, you must learn from the mistakes of others. You can't possibly live long enough to make them all by yourself. So in today's episode, we will discuss some of the worst investing mistakes you should never make. And welcome back to another whole episode of Rex, and stay connected to us by subscribing to our channel, and let's go. Number 1. We have collected 10 common mistakes gleaned from years of investing experience for you from various investors, and the first one on our today's topic is diversification. As it is popularly said, investors must not put all their eggs in one basket. You should allocate your different asset classes as your portfolio expands. This includes gold stocks, properties, shares, commodities, and bonds, so that you don't have to be dependent on any specific thing anymore. So when you go through any kind of market clash, you have your other investment backing you up. This kind of allocation of investment is called diversification, and is also a risk-reducing tool used by top tiers for centuries. The goal is to add independence by non-related markets from your primary plan, and you get an opposing source of income. So overall diversification can reduce portfolio risks and obviously increase overall return. Number 2. Coming on second is not giving your investment time to grow. Investment is all about time, and it is not an interest-based plan to keep it on the move as long as it can, but constantly watching over the ups and downs of price, and the high tendency to withdraw whenever the price has the slightest dominating over the normal rate is not appreciated. The investor has to hold his investment as long as they can to understand the potential of his investment. The problem with new investors is that of their high expectations in a short time. They just bail out the cash because they find the money is not doubled in the week. We should conquer the need for growth on an urgent basis as soon as possible, and instead give your investment the time to prove itself. We are not talking about situations where investments fail to deliver as anticipated. In such situations, we must cut losses and exit the plan. Every investor should understand whether this is all based on dud hoping. Number 3. Coming on third is the lack of goal for the investment. Setting a goal is important for every area of life, and so does your investment. It will make you determined and focused to achieve it without external motivations. Studies have proven that setting a goal restructures our brain cells to achieve them successfully. It keeps you out of casual approaches and makes you focused. Studies have also shown that methodical investors who have created a written plan have more likely outperform others in competition. A mathematical expectancy is a habit of a disciplined investor. It keeps you from jumping into hypes, runners, conjecture, or fake predictions. A goal of provable positive expectancy can make you more conscious, and your financial security deserves assurance more than hopes. Number 4. Coming fourth on our worst mistake is chasing the trends. Chasing the trends blindly can backfire, and it is one place you should restrain yourself despite the overwhelming inside hyped hopes. Most of the new investors tend to put their money in the next hotspot without doing proper research and solely based on the awesomeness of present news. Your investment deserves due diligence, and we must invest according to the rates of index funds and monitor the portfolio's growth. The trend doesn't always have to be necessarily a good idea. When investments are solely based on trends, it completely underlies the lines of risk. Investors must find out the reason behind impressive trends and understand whether it's sustainable to engage. A bullish market instills confidence and will end in people investing at a time when markets reach their peak. So study the past performance before engaging in such seasonal ups. Number 5. The fifth mistake is investing the money that you will soon need. Another worst mistake people make when it comes to investing is jumping into the market without securing a strong financial foundation. In order to avoid such mistakes, you should have a clear idea about your monetary necessaries and should build a cash reverse program so that you don't have to turn into your investment in hard times. Secure an adequate near-term financial backup. Experts even suggest not to invest the money you might be needing in the next 3 years of time. Number 6. Mistake number 6: timing the market. People often try to sell off their investments whenever they feel the market is going to crash, and such predictions often don't pay them well often. Research in the field suggests that we can't time the market at all. Not only does it disrupt your goal, these occasional redeems make you miss out on the benefits of compounding that helps you reach your goal. So try to focus on the large horizon and let the time smooth away such short volatiles. Number 7. The 7th point on our list is stopping investing when the markets are down. Stopping your investing can be a dangerous practice. Most investors don't realize the loss they are witnessing are just paper losses and not actual losses. It becomes only a loss when you withdraw your investment. Trust in the recycling nature of the market, and a bad or good cycle is not going to stay forever. The market correction will boost your investment into an upward trend. Number 8. Coming on 8 is not considering the inflation in return. We know the value of every product is not the same as it was 5 years ago. As years pass, the value will decrease even further. So inflation does decrease the money value and gradually lowers its purchasing capacity. So try to put your money on investments that can beat the order of inflation. Forecast the demand and monetary situation and try investing in products that can shield you from the value decreasing nature of money. Number 9 on our NIF is excitement. As Ford once said, emotions and investing are like oil and water. They don't really mix. So you should learn to make your decisions out of dispassion. Buying at a skyrocketing market condition is buying at an inflated price condition. Similarly, selling when the market is tanking is counterproductive for your long-term goals. Acknowledge your emotions and work calmly. Remember, it's usual for markets to go up and down. And when it comes to losing, instead of beating yourself up, consider it as an opportunity. Number 10. Lastly, placing excessive trust in experts. Everyone has a conflict of interest with your wealth except you. The helping institutions manage your investments because they get their fees, and advisors who sell their products receive a commission. So does the media for their advertising income and reach. So the important thing to remember is that everyone is focused on their wealth, and so should you. A good investor should think the advice received is biased. Everyone has their own bias about the market. That doesn't mean there aren't well-intentioned people out there. It's just that everyone is confused, just like you, and the projected confidence is based on the theory that the essence of investment is putting capital at risk. So the point is to not mistake opinions for facts, and there is really no investment truth. If you are an investor, develop a healthy skepticism. And good luck with your next investment. So hope you all have enjoyed the video. Like if you do. And see you all with a new episode. Bye.